Welcome to Short View Trading, your morning market hit for Monday, 13th of December. What matters today and this week for traders? Well, once again, equity markets demonstrated their resilience last week. After a very difficult down week at the end of November after Thanksgiving, followed by a choppy week at the start of December, last week proved to be very strong for equity markets across the globe. Indeed, the S&P 500 gained 3.8% on the week, its best week since earlier this year, as you can see on the chart in front of you now. And indeed, it wasn't just the S&P 500, it was across the breadth of US equity indices. In the chart in front of you now, the weekly gains, it wasn't just the S&P, the NASDAQ, amongst many others, the Dow, very strong weeks across the week. And indeed, it's the same case across the European equity markets, as you see on the chart in front of you now. And with that, volatility's died down pretty dramatically. As you can see in the VIX chart in front of you now, it's back at its 200-day moving average. The VIX candlestick chart showing you the VIX falling dramatically over the course of the last week as equity markets rallied. A similar sort of picture with the VVIX, which is the volatility of the VIX itself. Similar sort of pattern in that chart as well. As such, the bears have been pretty beaten up last week, and it leaves us with the question though, is this a false breakout? Or is this the start of a resumption of the uptrend and new record closing highs over many trading sessions over coming weeks? And indeed, the first input into that question is, where are we on our short-term market timing models? How greedy has the market become, or is it still a little bit fearful? And interesting, if you look at the put to call ratio that we're putting up in front of you now, this is a short-term 3-day smooth put to call ratio. It shows you there was indeed some put buying on Friday, some fear re-entered the market, and with that, this model retains its buy bias. Indeed, of course, that's one of only many models that we look at each and every day, which are laid out in our daily rag that we publish on the website, available to subscribers, or if you fancy a free trial, do click on the link below. But other pieces of evidence beyond the models include the fact that every time this year the S&P 500's touched its 50 or indeed its 90-day moving average, it's then proven a good support level with models on side at that time and the market resuming its uptrend. The bears would argue that the Fed's now tapering, it's a different world. We would argue that yes, the Fed is tapering, but they're still printing and creating new money. So liquidity is good, and that's the message of all our key liquidity models that we look at. And so whilst the Fed remains a risk with the meeting coming up on Wednesday that we'll talk about in the next section of the video, equally we're heading into that time of year when the Santa rally really gets going. Typically it starts mid-month December as markets quieten down and people leave their desks and the equity market just keeps edging higher. That's the case most years. Let's get beyond the Fed, then there'll be more confidence in that. But I don't think the Fed meeting will provide the fireworks the bears are looking for. So as mentioned, to see more on the Daily Rag, please do click on the link below for a free trial. Enter your name and email address and we'll send you the rag for free for 7 trading sessions. So what are we watching today and this week? Well, as already hinted at earlier in the video, it's central bank week. It's the Fed, it's the Bank of England, the ECB, the Bank of Japan, the Swiss National Bank, and so on. A whole wide plethora of central banks meeting this week and deciding upon monetary policy. The key, of course, absolutely is the Fed. What will the Fed do on Wednesday? It's the quarterly update of economic projections, the dot plots, which show you how each Fed governor is thinking about where interest rates are going. Added to that, there's a press conference with Jerome Powell after the meeting. Well, it's pretty well known in markets already that tapering is going to be accelerated, so no surprises are likely there unless they pick up the pace much faster than people expect. I think it's all eyes on the language in the statement, the language in the press conference, and how far those dot plots do shift up. Is it a case of the Fed simply catching up with the market, or is the Fed trying to get ahead of the market? All of that will be watched closely. My suspicion is the groundwork's been laid. The Fed's laid out its views about accelerating taper. They won't want to upset markets, and they will therefore be broadly in line with what people are expecting, or even slightly tilt to the dovish side, given this Omicron variant that's starting to emerge in the United States and across the globe. Elsewhere, the Bank of England probably won't raise rates, but that'll be watched closely on Thursday. So will the ECB and the Bank of Japan and the other central banks as mentioned. So that's it from us. That's your morning market hit for Monday, 13th of December. Thank you for listening. Please do subscribe to these videos on YouTube. Simply search under Short View Trading and click on the subscribe button, or follow us on LinkedIn, Twitter and or Facebook. Thank you for listening. Stay safe, trade well, and a very Merry Christmas.